Some Canadian homeowners write off more than $15,000 of interest on their taxes every single year. And this should not be possible, right? You've heard it your whole life. Mortgage interest in Canada is not tax deductible. But it's true. And here's the whole secret in one sentence. The CRA doesn't care that you borrowed money. It cares what you used it for. If you borrow to spend, a car, a trip, a renovation, not deductible. But if you borrow to invest in something that earns income and the same interest can be written off, that's the rule. Simple, right? Except the setup decides everything. Do it right and the government helps pay your interest. Do it wrong and you keep all the risk with none of the benefit. Now, I'm a mortgage broker licensed in BC and Alberta, and in this video, I'll show you the right way. Quick flag, I am a licensed broker and not a lawyer or your CPA. So make sure you check with your CPA how this applies to you. Now, let's get started. So here's the rule up close. There are 3 conditions, all are required. 1. The investment has to sit in a non-registered account. TFSA and RRSP don't qualify. They're tax shelters already, so the CRA won't give you a deduction on the way in. This is the most common mistake in the country. Borrowing on a HELOC to top up a TFSA feels smart and deducts nothing. Number 2, the investment must be the kind that can pay income. Dividends, interest, rent, dividend-paying stocks, most broad ETFs, a rental property, private lending, yes. Something with no income potential, held purely hoping the price goes up, offside. 3, direct use. The CRA follows the dollars. The borrowed money has to travel a clean, traceable line from the HELOC to the investment and stay there. Notice what this rule rewards: intention plus paper trail. It's not a loophole, it's the tax system treating investors the way it treats businesses. Which is why the structure matters more than the idea. Because the difference between deductible and denied usually comes down to one boring setup decision most people skip. So here it is. Your HELOC gets a dedicated segment, its own account or its own portion of the line used for investing and absolutely nothing else. Many lenders will in fact split a HELOC into portions for exactly this reason. One segment, one purpose, one clean train. The cardinal sin is mixing. Draw $50,000 to invest, $50,000 for kitchen, maybe something for taxes, and now you've contaminated this trail. Now you're doing forensic accounting to defend a percentage of your interest. Keep them separate from day one, and April every year will be simple. The statement for that segment is the deduction. Now, what's it actually worth? Say you draw $100,000 at prime plus half, that's 4.95% today, and just under $5,000 a year in interest. Now, if your marginal tax rate is 40%, a normal number for a decent income in BC or Alberta, the deduction hands you back about $2,000. Your true borrowing cost just dropped to under 3%. Same loan, same bank, same payment. The structure alone changed the price of the money. Pause right here and run this at your own marginal rate. The higher your bracket is, the bigger this gets. 2 more things that avoid it: sell the investment and spend the proceeds on personal stuff. Deductibility ends on that portion. The borrowed money is no longer earning income, and document everything: statements, transfers, purchase confirmations. Boring helps you win audits. And once you understand that machinery, there's a version that runs it automatically every single month, using your own mortgage payment as the engine. You may have heard the name, the Smith Manoeuvre. Here's what it actually is, stripped of the mystique. It needs a readvanceable mortgage, a mortgage paired with a HELOC, where every time you pay down the principal, your HELOC limit grows by the same amount. So each month your mortgage payment knocks, say, $2,000 off your principal. That $2,000 of new room appears on your HELOC. You draw it into your dedicated investing segment and buy income-producing investments. Repeat every month for years. Slowly, your non-deductible mortgage shrinks while a deductible investment loan grows in its place. You're now converting the worst kind of debt into the best kind, one payment at a time, and building a portfolio along the way without finding a single spare dollar of new cash flow. But understanding what you now have, your house is paid off and reborrowed, your total debt did not shrink, it changed clothes. The wealth comes from decades of compounding plus the tax conversion, not from a trick. Which brings me to the most important 90 seconds of this video. Now here is who should not do this. Skip borrowed money investing entirely if any of these sounds like you. Your income is lumpy and you have no buffer because the HELOC payment floats with prime and it arrives every single month whether your investments are up or whether they're down. You'd sell in a panic. Leverage means a 20% market drop hits harder, and this only works if you can hold through it. If you're carrying expensive consumer debt, kill the 21% credit card before you chase a 2% tax edge. Or let's be honest, you'd be tempted to borrow a little extra from the investing segment. The structure fails exactly where discipline does. Now remember, leverage amplifies whatever it touches: returns, losses, and personality. If the honest answer is not yet, the boring path, pay down your mortgage, max out the TFSA, is still a winning answer. So let me recap. The rule: borrow to earn income in a non-registered account with a traceable line, and the interest can be deductible. The structure: a dedicated segment, never mixed, documented to the penny. The Smith Manoeuvre automates this whole conversion, and if you have the right mortgage and the discipline, it could be a game changer. And even if this is not for you, that's a legitimate answer too. One thing before you do anything, even if we never speak again, is this video plus 1 hour with a good CPA in that order is your winning recipe. This is the mortgage decision and a tax decision equally. So talk to both professionals and see what version makes sense for you. The mortgage half is what I do. And if you want your file structured for this, a re-advanceable mortgage, a properly segmented HELOC, whether it's in BC or Alberta, make sure you book a call in the link below. We'll look at your equity, your renewal date, and with whether this even makes sense for you. And sometimes the honest answer is no. You'll get that too from me. And tell me in the comments, would you actually run this strategy, or is the simple, boring path more up to your speed? I read everyone and I try to advise if there's anything I can do to help you. Part 1 of this series explains HELOCs from the ground up, which is linked below and in the description. And if this 2-part taught you something, make sure you subscribe and leave a comment. This is Raghav Manchanda signing off, and I'll see you next week.